Okay, so you know that feeling.
Yeah.
When the bills start piling up
Yeah.
and you're like, whoa, okay, how am I going to stay afloat here?
Yeah.
It's something that like a lot of people go through.
Yeah, it is. Yeah.
But what if we could kind of like, take control of that a little bit more, really understand what's happening with debt and feel more in control?
Absolutely.
And that's what we're doing in this deep dive today.
Yeah, I think, a lot of people, when they think of debt, they think of it as this big, scary thing.
Right.
And it can feel really overwhelming to try and wrap your head around.
Right.
But we're going to break it down into some really manageable pieces. And hopefully by the end of this deep dive, you'll feel a lot more confident about how to manage your own debt.
Exactly. And there's so much information out there, right? It's like, where do you even start?
Yeah.
So think of this deep dive as like a crash course in debt management.
That's a great way to put it. Yeah.
We're going to look at the different types of debt. We're going to, give you some proven strategies to actually tackle that debt. And maybe even like surprise you a little bit with how even some of the wealthiest people out there think about and use debt.
Right.
So let's get started. So when we talk about debt, it's easy to just lump it all together, right? It's like one giant thing.
It's just this big, scary monster.
But in reality, it's made up of different parts,
Right.
different categories.
Exactly.
And we're going to focus on what I consider like the big three.
Yeah.
And that's credit cards,
Okay.
loans,
Uh-huh.
and mortgages.
Yeah, the big ones.
So let's start with credit cards. I mean, these are, those little pieces of plastic that we all have in our wallets
Right.
and use pretty regularly.
All the time.
So can you explain a little bit about like how credit cards actually work?
Yeah, so credit cards work on this idea of what's called revolving credit. So that means you have a certain credit limit,
Okay.
and you can borrow money up to that limit,
Right.
and then you can either pay it off in full at the end of the month, or you can carry a balance over from month to month.
Right.
And that's where the interest comes in.
Oh, yeah. The interest rates can be scary.
They can be, yeah. And typically, credit card interest rates are pretty high.
Yeah.
You're looking at anywhere from, say, 15 to 25% APR,
Yeah.
which is annual percentage rate.
Okay.
So that's a pretty significant chunk of change.
Yeah, especially if you're carrying a big balance.
Absolutely.
So what's like the best strategy when it comes to using credit cards?
Well, the absolute best strategy, if you can manage it, is to pay off your balance in full every single month,
Okay.
because that way you avoid paying any interest whatsoever.
So you're basically getting like a free short-term loan
Right.
if you pay it off right away.
Exactly.
Yeah.
But obviously life happens, and sometimes you can't always pay off your balance in full every month.
Right.
So if you do find yourself carrying a balance, there are a couple of different strategies you can use to tackle that debt.
Yeah.
And one of the most popular and effective methods is called the avalanche method.
Okay.
Have you heard of that one?
I have, yeah.
Okay, so the avalanche method is really all about focusing on the math,
Okay.
the numbers.
Yeah.
So what you do is you list out all of your debts
Okay.
in order from the highest interest rate to the lowest interest rate.
Got it.
And then you make the minimum payment on all of them.
Uh-huh.
But any extra money that you have available,
Yeah.
you put towards the debt with the highest interest rate.
Okay.
And you keep doing that until that debt is paid off.
Yeah.
And then you take all of that money that you are putting towards that debt
Yeah.
and you move it to the next highest interest rate debt.
Right.
And you just work your way down the list.
Like an avalanche.
Right.
Yeah.
It's a very efficient way to minimize the total amount of interest that you pay over time.
It makes sense. Now, what about those like 0% APR periods that you see advertised sometimes?
Oh yeah, those introductory offers.
Yeah. Those can be tempting.
They can be, yeah, and they can actually be a really good tool
Okay.
if you use them strategically.
Okay.
So for example, let's say you have a big purchase coming up.
Uh-huh.
Maybe you need to buy a new appliance or something like that.
Right.
And you don't want to pay interest on that purchase.
Yeah.
You could get a credit card with a 0% introductory APR period.
Okay.
And then you would have a certain amount of time, maybe 12 months or 18 months
Right.
to pay off that purchase without accruing any interest.
And that could save you some money.
It could.
Yeah.
Yeah. But here's the catch.
Yeah.
A lot of people fall into this trap of not actually having a plan
Yeah.
to pay off that balance before the introductory period ends.
Yeah.
And then all of a sudden,
The interest rate jumped up.
it jumps way up.
Yeah.
And you could end up paying more in interest than if you just used your regular credit card in the first place.
Right.
So it's really important to be aware of that.
It's almost like a ticking time bomb.
It is, yeah. It's like you're playing beat the clock.
Yeah. You gotta know what you're getting into.
Absolutely.
Okay, so we've talked about credit cards.
Yeah.
Let's move on to loans.
Okay.
And these just feel a little bit more structured than credit cards.
Yeah, they definitely do.
Yeah.
I mean, you typically have a set repayment period
Right.
and a fixed interest rate.
Yeah.
So there's a little bit more certainty there.
Yeah, I feel like, when I think of loans, I think of like a car loan or
Right.
student loans.
Yeah, those are common types of loans.
Yeah.
Personal loans as well.
Right.
Which are a little bit more general purpose.
Okay.
You can use those for a variety of different things.
So can you talk a little bit about like what are some of the key things to understand about loans?
Yeah, one of the first things to understand is the difference between a secured loan
Okay.
and an unsecured loan.
Yeah. What's that about?
So a secured loan is backed by some sort of asset.
Okay.
So for example, a car loan.
Uh-huh.
The car itself is the collateral for the loan.
Okay.
So if you default on the loan,
Yeah.
the lender can repossess the car.
Oh, right.
A mortgage is another example of a secured loan.
Yeah, your house.
Your house is the collateral.
Right.
Now, an unsecured loan, on the other hand,
Yeah.
is not backed by any specific asset.
Okay.
So a lot of personal loans
Right.
are unsecured.
Okay.
Student loans are also unsecured as well.
Okay.
And because they're not secured by an asset, they tend to have higher interest rates.
Okay, that makes sense.
Yeah.
If there's more risk involved for the lender, they're going to charge more interest.
Right, exactly.
So you mentioned interest rates. What are some of the typical interest rate ranges that we see with loans?
Yeah, so it really depends on the type of loan and your creditworthiness.
Okay.
So personal loans
Mm-hmm.
can vary quite a bit.
Yeah.
You could see rates anywhere from, say, 6%
Okay.
all the way up to 36%.
Wow, that's a huge range.
It is a huge range.
Yeah.
Auto loans tend to be a little bit lower,
Okay.
maybe in the 4 to 10% range.
Okay.
And student loans often fall somewhere between 5 and 12%.
Okay.
But again, these are just general ranges.
Right.
Your actual interest rate is going to depend on your individual circumstances.
So it really pays to shop around and compare.
Absolutely. Yeah.
Yeah.
It's always a good idea to get quotes from multiple lenders before you commit to a loan,
Right.
so you can make sure that you're getting the best possible rate.
Yeah, that's good advice. So say you have some loan debt. What's the best way to approach like paying it off?
So with loans, consistency is really key.
Okay.
I mean, because you have that fixed term and that set payment schedule,
Hmm.
it's really important to make your payments on time every month.
Right.
Avoid late fees and keep your credit score in good shape.
That makes sense.
But another thing to consider is refinancing,
Okay.
especially if interest rates have gone down since you originally took out the loan,
Right, or if your credit score is improved.
or if your credit score is improved. Exactly.
Yeah.
So refinancing basically means that you're replacing your existing loan
Okay.
with a new loan that has a lower interest rate.
Okay.
And that can save you a lot of money in interest over the life of the loan.
That's a good point.
Yeah, and just like with credit cards, if you have multiple loans, it generally makes sense to prioritize paying down the ones with the highest interest rates first.
Right, because those are the ones that are costing you the most money.
Exactly.
Okay.
You want to get rid of those as quickly as possible.
So we've covered credit cards, we've covered loans.
Yeah.
And now the big one, the elephant in the room, mortgages.
Yeah, the mortgage.
I mean, this is for most people the biggest financial commitment they'll ever make.
It is for a lot of people, yeah. I mean, it's a huge decision,
It is.
and it's a big responsibility.
So what are some of the key things that people should know about mortgages?
Well, as we mentioned before, a mortgage is a secured loan
Right.
that's specifically for buying a home.
Okay.
And the home itself is the collateral for the loan.
Right.
So if you start making your payments, the lender can foreclose on your home.
Oh, that's scary.
Yeah, it is. It's definitely a risk that you need to be aware of.
Yeah.
But the good news is that interest rates on mortgages tend to be lower than credit cards or other types of loans.
Okay.
So, typically you're looking at interest rates in the 3 to 7% range.
Okay.
But again, that can fluctuate depending on market conditions.
Right.
And mortgages also have much longer repayment terms than other types of loans.
Yeah, you're talking 15 years, 30 years.
Yeah, 15 years, 30 years, sometimes even longer.
Wow.
So that means that you're going to be making payments for a long time.
A long time.
But it also means that your monthly payments are going to be lower.
Okay, that's good.
which can make it more affordable to buy a home.
Yeah.
But because the repayment term is so long, a significant portion of your early payments are going to go towards interest.
So how do you pay off a mortgage more efficiently?
Well, one of the best things you can do is to make extra payments on the principal.
Okay.
So the principal is the actual amount of money that you borrowed.
Right.
And by making extra payments on the principal, you can reduce the total amount of interest that you pay over the life of the loan.
And that means you can pay it off faster too, right?
Yeah, exactly.
Okay.
Even a small extra payment each month can make a big difference over time.
Wow.
Yeah, it's really amazing how much of a difference it can make.
That's a good tip.
And of course, just like with any loan, it's important to shop around and compare offers from different lenders when you're getting a mortgage. Make sure that you're getting a good interest rate and that you understand all of the terms and conditions of the loan.
Right, because even a small difference in the interest rate can make a big difference.
It can, yeah.
Yeah.
Especially over a 15 or 30-year period.
Yeah, that's a long time.
It is.
Okay, so we've covered the 3 main types of debt.
Yeah.
Credit cards, loans, and mortgages.
Right.
And we've talked about some of the key things to understand about each one. So now let's talk about some of the practical strategies for actually managing your debt and getting it under control.
Right, because knowledge is one thing.
Right.
But action is another.
Exactly.
Yeah.
Yeah, it's not enough to just understand how debt works.
Right.
You have to actually do something about it.
You have to take action.
Right? So what are some of the things that people can do to start taking control of their debt?
Well, the absolute foundation of any successful debt management plan is creating a budget.
Okay.
You have to have a clear picture of where your money is coming in,
Yeah.
where it's going out.
Yeah.
And a lot of people find that it's helpful to use a budgeting tool or app
Okay.
like Mint or YNAB, which stands for You Need a Budget.
YNAB.
Yeah.
Okay.
So these tools can connect to your bank accounts, your credit card accounts, and they can track your spending for you.
Okay.
And they can also help you to categorize your expenses
Right.
so you can see where your money's going.
So you're not like, where did all my money go?
Right, exactly. And
Yeah.
and once you have a good understanding of your spending habits, then you can start to make adjustments.
Okay.
So you can free up more money to put towards your debt.
Right.
And one helpful guideline that a lot of people use
Okay.
is the 50-30-20 rule.
The 50-30-20 rule.
Yeah, have you heard of that one?
Yeah, I think so.
Okay, so the 50-30-20 rule suggests that you allocate 50% of your after-tax income to your needs.
Okay.
So things like housing and food and transportation.
Right. The essential.
The essentials, yeah. 30% to your wants.
Okay.
So things like entertainment and dining out and travel.
The fun stuff.
The fun stuff, yeah.
Yeah.
And then 20% to savings and debt repayment.
Okay.
So that's a good starting point.
Yeah.
It's not a hard and fast rule,
Right.
but it's a good framework to start with.
Yeah, a good guideline.
Yeah.
Okay, so we've got a budget in place.
Yeah.
We're tracking our spending.
Right.
We're using a budgeting tool, maybe.
Uh-huh.
Now, let's talk about those 2 main debt repayment methods that we touched on earlier.
Okay.
The debt snowball and the debt avalanche.
Right.
So can you break down each of those for us a little bit more?
Sure.
So let's start with the debt snowball.
Okay, so the debt snowball method is all about building momentum
Okay.
and staying motivated.
Yeah.
So what you do is you list out all of your debts from the smallest to the largest,
Right.
regardless of the interest rate. So you might have a credit card with a really high interest rate, but if it has a small balance, it's going to be at the top of your list.
Got it.
And then you make the minimum payments on all of your debts except for the smallest one.
Okay.
And on that smallest debt, you throw every extra dollar that you can find at it.
Really go after it.
You go after it, yeah.
Yeah.
And you keep doing that until that debt is gone.
Okay.
And then you take the money that you were putting towards that debt and you roll it into the next smallest debt.
Okay.
And you just keep snowballing your way down the list.
Okay, so you're kind of getting those quick wins early on.
Exactly.
Yeah.
You see those smaller debts disappear.
Yeah.
And it gives you a sense of accomplishment.
Yeah.
And it helps you to stay motivated.
Okay, so it's really focused on like the psychological side of debt repayment.
It is, yeah.
Yeah.
It's about staying motivated and building momentum.
Okay, now the debt avalanche, this one's a little different.
Yes.
And this is more about like maximizing your financial savings. Right.
So how does that one work?
So with the debt avalanche method, you list out all of your debts from the highest interest rate to the lowest interest rate.
Okay, so it doesn't matter the size of the balance.
Right. It's all about the interest rate.
Got it.
So even if you have a small debt with a really high interest rate,
Yeah.
it's going to be at the top of your list.
Okay.
And then you make the minimum payments on all of your debts except for the one with the highest interest rate.
Mm-hmm.
And you put every extra dollar that you have towards that debt.
Until it's gone.
Until it's gone, and then you move on to the next highest interest rate debt,
Okay.
and so on and so forth.
So you're basically trying to minimize the total amount of interest that you pay.
Exactly. And
Yeah.
mathematically,
Yeah.
the debt avalanche method is the most efficient way to do that.
But it might take a little longer to see those initial wins.
It might,
Yeah.
Because if your highest interest rate debt also has a large balance,
Right.
it could take a while to pay it off. Okay, so it's really a trade-off between the psychological benefits of the snowball
Right.
and the financial benefits of the avalanche.
Exactly.
Yeah,
So it
yeah.
really comes down to what works best for you.
Yeah, what's going to keep you motivated.
Right.
Okay, so we've talked about the snowball and the avalanche.
Mm-hmm.
What about debt consolidation?
Oh, yeah. Debt consolidation.
This is a term that I hear thrown around a lot.
Yeah, you hear it a lot.
Yeah.
So debt consolidation is basically the process of combining multiple debts
Okay,
into a single new debt.
okay,
And the goal is usually to get a lower interest rate
okay.
or more favorable repayment terms.
So how do you actually go about doing that?
Well, there are a few different ways to consolidate your debt.
Okay,
One common method is to use a balance transfer credit card.
okay.
So you transfer the balances from your high interest credit cards
Yeah,
to a new card that has a 0% or low introductory APR.
right.
Another option is to take out a personal loan and use that loan to pay off your other debts.
Okay.
And some people even tap into their home equity
Mm-hmm.
through a home equity loan or a line of credit to consolidate their debt.
Okay.
So there are a lot of different options available.
Yeah, it sounds like it.
Yeah.
So what are some of the pros and cons of debt consolidation?
Well, one of the big pros is that it can simplify your payments.
Yeah.
Instead of having multiple payments to keep track of,
Uh-huh.
you just have one payment to make each month.
Okay.
And that can be really helpful for people who are feeling overwhelmed by their debt.
Yeah.
Another pro is that if you're able to get a lower interest rate on your new debt,
Yeah.
you can save money on interest over time.
Right.
But it's important to remember that debt consolidation doesn't actually reduce the total amount of debt that you owe.
Okay. It just kind of restructures it.
It restructures it, yeah.
Oh, yeah.
And if you don't address the underlying spending habits that led to the debt in the first place,
You're right.
you could easily end up back where you started.
Yeah. Or even worse.
Or even worse, yeah.
Right.
So it's really important to use debt consolidation as a tool to get your finances back on track.
Yeah.
But it's not a magic bullet.
Right.
You still have to do the work.
You still have to be responsible.
Absolutely.
Okay. So are there any other options for people who are struggling with debt?
Yeah, definitely.
Really?
So one option is to negotiate with your creditors.
Okay.
So you can try to work out a payment plan that fits your budget.
Yeah.
Or you can ask for a lower interest rate.
Okay.
Or maybe even a temporary forbearance on payments
Okay.
if you're going through a difficult time.
Yeah.
And another option is to contact a nonprofit credit counseling agency.
Okay.
So these agencies can provide free financial guidance.
Mm-hmm.
They can help you create a budget.
Okay.
And they can also help you to develop a debt management plan.
And they're not trying to sell you anything.
Right, they're not trying to sell you anything. They're just there to help you.
Right.
And they can also sometimes work with your creditors on your behalf.
That's good to know.
Yeah.
Okay, so we've covered a lot of ground here.
Yeah, we have.
We've talked about different types of debt.
Right.
We've talked about some practical strategies for managing debt.
Mhm.
But now let's kind of shift gears a little bit.
Okay.
And talk about something that might seem a little bit counterintuitive.
Yeah, this is where it gets interesting.
Yeah, this is where it gets a little weird.
Yeah.
We're going to talk about how some of the wealthiest people in the world,
Okay.
specifically billionaires,
Billionaire.
often use debt.
Yeah.
I know it might seem strange
It does?
because, when we think of billionaires, we think of people who have tons of money.
Right.
They don't need to borrow money.
Right. You would think they wouldn't need to.
Right.
But a lot of billionaires actually use debt strategically to grow their wealth.
Okay, so explain that to me.
Okay, so the basic idea is that they borrow money at a low interest rate.
Yeah.
And then they invest that money in assets that they expect to generate a higher return.
So they're basically using debt to make more money.
Exactly.
Okay.
And they're using other people's money to do it.
Oh, okay.
So, for example, a billionaire might take out a loan for $100 million.
$100 million.
Yeah.
Okay.
At an interest rate of, say, 3%?
3%.
Yeah.
Okay, that's pretty low.
Yeah, it's very low.
Yeah.
And then they might invest that $100 million in a real estate development project
Okay.
or a startup company or something like that.
Right.
That, they think, is going to generate a return of, say, 10%.
Okay.
So they're making 7% profit on that money
Okay.
that they borrowed.
Right. They're using leverage.
Exactly. They're using leverage
Okay.
to amplify their returns.
Right.
And of course, there's always risk involved.
Yeah, because what if that investment doesn't pan out?
Right.
Yeah.
If that investment goes south, they could lose a lot of money.
Right.
But billionaires are typically very sophisticated investors.
Yeah.
And they have a high tolerance for risk.
Yeah.
So they're willing to take on that risk in order to potentially earn those higher returns.
So it's a calculated risk.
It is, yeah.
Yeah.
But it's not a risk that everyone can afford to take.
Right.
Especially not people who are already struggling with debt.
Yeah.
You know, if you're already having trouble making ends meet,
Right.
taking on more debt is probably not a good idea,
Probably not, yeah.
no matter how good the potential return might be.
So there are some pretty significant differences between how billionaires use debt
Right.
and how the average person uses debt.
Absolutely.
So can you kind of like spell out those differences for us a little bit more?
Sure. So, first of all, billionaires have access to much lower interest rates than the average person
Okay.
because they have excellent credit. And they have a lot of assets that they can use as collateral.
Okay.
And they also have relationships with banks and other lenders
Right.
that the average person just doesn't have.
Right.
So they're able to borrow money on much more favorable terms.
Yeah.
And secondly, billionaires typically have very diversified investment portfolios.
Okay.
So they're not putting all of their eggs in one basket.
Right.
They're spreading their risk across a variety of different assets.
Right.
And that helps to protect them from losses.
Oh.
If one investment goes bad, they have other investments that are doing well.
Okay.
And finally, billionaires have a much higher tolerance for risk than the average person.
Yeah, they can afford to lose more.
Right. They can afford to lose more,
Yeah.
and they're also more likely to be comfortable with volatility.
Right.
You know, their investments might go up and down in value,
Yeah.
but they're not going to panic and sell everything at the first sign of trouble.
Right.
They have a longer-term perspective.
Right. And they have the resources to kind of like ride out those waves.
Exactly.
Yeah.